Hi, my name is Arun, and today I'm going to talk about how do you write put options on Degiro and how you are handling assignments on the Degiro platform. Options are risky, and this video I have recorded only for learning and educational purposes. Okay. Maybe before we go into the actual trade on the Degiro, let's look at what do we mean by selling put options. Yes. So what is writing put? It's a strategy which people use to generate income, example via wheel strategy, or people are also using this strategy to buy stocks at a reduced price. When you're writing a put, the writer agrees that he will be buying the underlying stock at the agreed strike price. In simple terms, basically the stock will be put to you if the option is in the money at expiry or it is exercised. In this example here, if you the actual trade is Nokia, which I have done. And if you look here, the maximum profit for such a trade is the premium which is collected minus the broker fee from the start. So if for my trade, I have used Nokia, and the strike price which I have taken was €3.50, and the premium which I have collected was zero point 0.2 cents per contract. So which means my cost basis for the shares, if it will be assigned to me, will be 350 minus 20 cents, which is like 30 cents per share. Of course, it's an unlimited loss strategy, which means in this case, I can have a maximum loss of uh, €3.50 multiplied by 100 shares per, which is per contract. So if I buy, let's say, two contracts, then the maximum loss I will have by this strategy is €700. So let's look at the trade which I have done. So the trade uh, here is Nokia. So what I've done is on 27th of January, I have sold two contracts of Nokia on 27th at a strike price of 350. So on the left hand side, what you see is the share price from the day I've entered into the trade to the uh, expiry date, which was 19th February, the last Friday. If you look here on the right hand side, my entry point was here, which was I collected 20 cents here. This, if you see here on 27th here, and then I have done trade with two contracts. So basically, I collected €40, selling contracts of Nokia at 20 cents each. So this is basically showing a graph how the share price has traded till the time of expiry versus the option this. If you see here, if I have entered into the trade earlier, I could have collected for the same trade €80 for two contracts. So basically for different options, you can time what you can collect the premium as well. Generally, it's 30 to 45 days, which is recommended by the experts. So let's look at how it was trading. So on 11th of February, these two contracts of Nokia, if you see here, which I've sold, it was giving me a profit of 32 percent. So if I could have sold it on this day, I could have collected let's say 11 euros 50 cents. Of course, I collected 40 euros, like if you see here earlier, but then I have to really buy back this contract at 13.50, and then in the end, my only profit is 11.50. Yeah, and minus the fee, which it already includes the fee as well. On 17th, 2 days before expiry, the same contract was giving me 1550. So I need to really buy back this contract, and the overall profit would have been only 1550 euros for these two contracts. I could have closed this trade at this time by buying it back from here, and then of course then my total profit would have been 15 euros and 50 cents for these two trades. If we look at the actual trade, so this is how the share price was till the expiry. If you see this red line, if the share price is above this line, at the expiry date, I would have kept the all the premium the there, and of course there was no assignment to me. But if you as you see here, during the expiry date, the share price was trading below the 350 strike price, which means it was uh, trading low. And then on the 19th, I was assigned these shares for those two contracts, which means I was assigned 200 shares of Nokia on 19th of February. Let's look into how it actually looks from the cost perspective. If you look here, I entered into a trade on 27th, strike price 350, and then I bought, sorry, sold two puts uh, at 20 cents each. So basically, I collected 20 euros, and then of course I paid a fee of 75 cents per contract. So basically, it was 38.50 is what I collected in the end. And if we look here now on the 19th, since the price was less than 350, less than my strike price, so I was assigned these 200 shares at the price of 350, because this is a price this was the strike price, which means I had to pay 700 euros to get these 200 shares of Nokia. And then, of course, uh, I had the cash which was securing these puts. So that's why we also call it cash secured puts as well. If we look, what are the actual costs? So if you see here, so this was 40 euros is what I collected. This was the fee. And then this was my account balance, 635, which was less than the 700, which was needed to get these shares. So on the day of the expiry, I was assigned these 200 shares at 350 price. So if that's what is showing here, this 700, because I had two contracts. And what you see also here is I have to pay a fee of 2 euros as well, which is 1 euro per contract for the assignment. Yeah. So this is the fee when you are assigned, which you have to pay additionally. If you see here, my account had 3635, and then I paid 702, and this is, let's say, the my account balance now as we speak. So if you are not trading on a portfolio margin, or if you have a, let's say, higher uh, balance requirements, then there will be a margin call which will be put to you by the broker, and then of course based on that, either you need to close your positions or you need to pay that money back. Okay. So now what happens? So now, as we speak, I own 200 shares of Nokia, and my cost basis is 350 minus premium collected. So my share cost is 3 euros 30 cents, and the current traded price is 3 euro 40 cents. So basically, by writing put, I have reduced the or lowered the price of the shares, and now this is what I own. So I own 200 shares, and this is my account currently balance for this one. So what do I do now? So as a next step for me, I will sell a call for these two contracts and collect premium again. And this way I will do the wheel. And if those shares are called away from me, I will sell the puts again. So I will do that wheel again and again, and in the process collect premium as I go along. In case you have liked the video, please like and subscribe. Thank you. And if you have more questions, please write in the comment section. I will try to answer them as soon as possible. Thank you. Bye.